while the Fed was hiking, consumers had at one point $2.5 trillion of excess savings in their savings accounts because of all the stimulus checks that went out. And so the normal impact of a rate hike didn't occur because you had all that excess savings. Now, by most estimates, all that excess savings of 2.5 trillion has been burned through for 90% of the population. So are you going to see some of that starting to hit finally?
How will Fed monetary policy affect markets this year? Which markets will be affected the most? And how will tech stocks perform? Can we still see the same gains in the Magnificent Seven stocks like we saw in 2023? Let's find out with Dan Niles, the founder of Satori Fund. Dan has had more than 30 years of experience in the investment industry, having served in senior leadership positions at investment banks such as managing director at Lehman Brothers. First, a word from our sponsor, CoinLedger. If you are a crypto investor, then you know how cumbersome it can be to report your crypto transactions on taxes. There is a simpler way. CoinLedger is a crypto and NFT software which does your tax reports for you. Just sign up for a CoinLedger account and link your crypto wallets to it. That's all there is. CoinLedger will then automatically generate a tax report for you based on your transaction data. This tax report can be sent to any tax filing software, TurboTax, TurboAct, Wealthsimple, etc., or just passed on to your accountant. CoinLedger's tax report will be even generated in your local currency if you choose. The software supports DeFi and NFTs. CoinLedger is the highest rated cryptocurrency tax software platform in the world right now, which is why over 500,000 investors already use CoinLedger to help file their taxes. Use my promo code with the link in the description down below and start saving time on your tax filings with CoinLedger. Don't get caught off guard this tax season. Welcome to the show, Dan.
My pleasure, David.
Dan, you've got a long career working at some of the top banks and financial institutions in the world. Tell me first about your investment philosophy before we get into specifically what's going on right now with the economy. Are you more of a top-down portfolio manager? Are you an events-driven guy? Are you a technical analyst? How do you manage money is my question.
Yeah, I mean, I think the number one thing we try to do is we try not to lose money. And so
Okay.
I call it running an all-weather strategy where we are focused primarily in large cap technology stocks. We have both longs and shorts. And the goal is whether the NASDAQ's getting killed like it was in 2022 or it's straight up like it was in 2023, either case, the goal is to hopefully make money and that the longs and shorts balance out. In terms of the strategy, we try to focus on both top down. So what's the Fed going to be doing? How's that likely to impact the overall market? As well as bottoms up in terms of are there some big trends going on like artificial intelligence, obviously recently, that could really impact individual stocks or sectors within the overall market that enables it to perform or underperform relative to what the overall tape's doing. And so that's kind of what our focus is and how we think about things, both big picture as well as company specific.
And we're going to get into company specific in just a minute. When it comes to picking stocks, can you outline your overall strategy there? Are you a value picker or investor rather? Do you pick quality? Do you look for certain metrics and screen for those?
Yeah, for us, we are at heart, we're a growth at a reasonable price type of investors. And so what we're trying to do is balance risk versus reward and look at stocks and through that lens. And so we try to invest in profitable companies. We try to invest in ones also that are larger capitalization, that have been around for a long time versus sort of concept stocks where you have to believe they're going to be profitable a decade from now and hope and pray that that works out. So that's not something we're that interested in.
Okay. One of your top picks is Amazon. We're going to get into your top picks in more detail, but tell us about why Amazon you believe has some of the most potential upside of the Magnificent Seven stocks. You've seen the news, obviously, tech stocks are going through, or certain tech companies are going through rounds of layoffs, Amazon being one of them. Certainly it doesn't look good in the news, but you've got your reasoning. I'm curious to hear it.
Sure. I mean, if you look at Amazon, when COVID hit, everybody had to go online to buy things.
Sure.
And so e-commerce demand exploded. And as a result, Amazon invested a ton of money into distribution centers, shipping centers, et cetera. Then what happened was obviously we all came out of COVID. We all wanted to get out and do things. And e-commerce demand absolutely dropped faster than anybody, including Amazon, expected. And so they had all of this excess capacity in the system. What you're seeing now is we've gone through some period of time where now they've grown into that, and now you're starting to see margins really starting to expand. And so that, as those revenues flow through underutilized distribution, you end up with tremendous amount of margin leverage. In addition to that, you've got AWS, Amazon Web Services, which is their cloud division. That's seen growth decelerate, much like you saw with e-commerce, obviously, seen growth decelerate really since the fourth quarter of 2021 when it was growing at 40%.
Mm-hmm.
In the June quarter, September quarter, that kind of bottomed out at 12% growth. September, you actually saw that reaccelerate to 13. And that's incredibly high margin business. And in addition to that, you have Amazon starting to show ads on their Prime Video service, and that's 60% operating margin business versus high single-digit operating margin business for the rest of the company. So in summary, our belief is that EPS can double by 2025 into the $5 to $6 range on a GAAP basis versus where it is for calendar 23, which is right around $2.83 or so. So
Sorry, yeah, please continue.
yeah, so that's basically it. And the nice thing is if you do end up with a recession in the back portion of this year, Amazon has shown it's a share gainer during recessions. Obviously, the multiple will be impacted, but they should be able to pick up share going through a recession just like they did the last couple of times.
And if and when we do get a recession, how much of their subscription services would be affected? Are people usually habitual creatures in the sense that they don't cancel their Prime subscription, or I'm just using the Amazon example, but it could apply to Netflix, could apply to Microsoft Office or any other subscription service. Do people usually not cancel those during a recession?
Well, remember, you've got Prime is not just for movies, obviously. That's something that
Yes.
gets thrown in with the shipping, et cetera, that comes with it. And
Sure.
so it's going to be one of the last things you probably end up canceling because you do get free shipping. I think all of us during COVID got used to ordering things, essentials, even over Amazon, and given you've now got deliveries that'll show up in a couple of hours from when you do it, it's certainly a lot more convenient than having to go all the way to a store and buy and come back, et cetera, to do it through Amazon. So yes, there's obviously when an economy slows down, everything gets impacted. But I think Amazon will be one of the last ones to get impacted. And on the flip side, if you're becoming more cost conscious because it is a recession, just like what we saw in 08, 09, or recently during COVID, which obviously isn't as relevant given you had to shop online, you should see share gains continue with this company because of those reasons.
Sure. Generally speaking, would you say that these large tech stocks are more akin now to utility companies because of their subscription cash flow or consistent cash flow nature of the business?
Yeah, I don't think so. I think you have to go through each company
Hmm.
very specifically to break that out, because investors desperately want to believe that, which is why you've got valuations at some of the levels where you've got it. But you look at an Apple, for example, and they guided down 5% for the March quarter. The expectations were revenues would grow 1% for the March quarter. But you look at it, that's the same revenues they had 3 years ago. So you've literally had no growth for 3 years, and you've got a high 20s PE for the company with the S&P trading at 20 times.
Hmm.
So at a certain point, valuations and growth tend to start to match up. But what you've seen the last 2 years is 2 years ago, tech stocks all got killed in a basket. Last year, tech stocks all went up in a basket. But if you look at this year so far, you've started to see that split apart, right? You've seen Tesla with their estimates going down,
Yeah.
stocks down for the year. You've seen Apple, their estimates are going down. And by the way, estimates went down all last year. It didn't really matter for Apple then, but you're starting to see that have some impact for the stock. Meanwhile, on the other end of the spectrum, you've got Facebook, which is up over 20% this year. You've got NVIDIA obviously doing incredibly well, where people think estimates are going to go up a lot more when they report. Amazon, obviously, the stock's up a lot. And then you've got in between, in the middle, Microsoft and Google. So you've already started to see the performance of the Magnificent Seven, as they call it. I kind of think of them more as the Fantastic Four, I guess, which
Okay.
I kind of don't put Google or Apple or Tesla in the same basket, and we can get into why. But I think you're going to start to see, as the economy slows further as we go through this year, that the performance amongst these companies is going to split even further than it's already split. And the stocks should follow suit, where they really haven't over the last 2 years, where they've sort of traded as a monolithic basket to some degree.
Okay, well, let's get into that. Yeah, which of these Magnificent Seven, or I guess not discounting your Fantastic Four category, which of these seven stocks do you think will perform the best, and which will lag its peers in the group?
Well, we already talked about Amazon and why there. If you look
Right.
at Meta is really the one that's using AI in their own business. And so they're using artificial intelligence to help give you recommendations of what videos you should watch, which is leading to high engagement on the platform. They're also using AI to help monetize the ads that they're showing. And so if you look at the most recent quarter, obviously they had enough confidence in their future growth that they actually issued a dividend for the first time. They'll start paying. And so I think that's going to really help the multiple out a lot as well going forward, because that's going to open up the stock to a whole bunch of investors that can't own anything without a dividend. And the valuation, mid-20s PE against revenue growth in the mid-teens, that's very compelling, especially when you look at the S&P, and it's trading at about 20 times with 5% revenue growth. If you kind of go down the list, NVIDIA, obviously, it's trading at a mid-30s PE, and the revenues are growing at 70%. And I think you'll see massive beats and raises for the next 2 quarters, because if you think of AI really is enabled by the chips that NVIDIA provides, and they're just gated by how many chips that they can produce. And so I think you're going to see very good quarters going forward. And mid-30s PE for something like that is obviously pretty compelling. Microsoft on the software side is really the company that's benefiting. Obviously, they own almost half of OpenAI, which produced ChatGPT. You're seeing that in their revenues, which are growing very fast for Azure, which is their cloud business. And so for that, it's not cheap, obviously, mid-30s PE, but it does have a very durable business to some degree, in that 90% of the businesses are on Microsoft operating system. People are going to use that. They're using AI to introduce, obviously, something called Copilot, which will help your productivity. So I think that's pretty interesting. The flip side, we already talked about Apple. And the biggest issue with Apple, quite honestly, is rising competition from Huawei, which didn't have a new smartphone since 2019, when we cut them off from chips based on the Trump administration at that time. They introduced a new smartphone recently, late last year, and that's gaining a tremendous amount of share. So at one point, they used to have 16% global market share in 2019. That dropped into the low single digits. We think that's going to go back. That's going to take some bite out of Apple to some degree. And in addition to that, you've got phones from Samsung that already have AI built into it. And the foldable category, now that they've solved some of the screen crease issues, is also starting to pick up share, which Apple doesn't have. So at the PE that it's trading at, with no growth, it's really hard to say that the risk is balanced by the reward in the stock, especially given its premium multiple. Tesla, obviously, margins keep going down in automotive. PE is very high at 60 times. Obviously, a lot of discussion around the CEO's behavior. I think it's a difficult stock to own based on the fundamentals right now, because you are seeing estimates continue to go down for it, and competition's pretty fierce. And so I think that's kind of how I would think of each of the Magnificent Seven separately.
Let's just talk about Apple for just a minute. How likely is it that the Chinese government will ban Apple in China?
It's honestly not something I'm looking at. I don't think they're going to ban it in China, because at the end of the day, China's got a growth problem. So they desperately want growth to be good, so they don't have social unrest. And you're seeing it in the Chinese stock market, which is absolutely getting destroyed over the last several years, particularly since China cracked down on the Ant Financial IPO by Alibaba in November of 2020. And
Hmm.
so you're hearing a lot about them wanting to support their markets. And if you look at Apple, they are a massive employer of through Foxconn, which produces phones for Apple. And so I don't think that's going to happen. Now, will they go ahead and say, hey, we don't want any of these phones at government facilities, state-owned enterprises, any place we think is critical? Absolutely. Because would they rather have Huawei do well relative to Apple? Absolutely. So is there going to be continued pressure on Apple? Yes. And
Hmm.
so I think at this valuation, it's very hard. Stocks can stay irrational for longer than you ever imagined. And so with Apple, I look at the fact that the stock is up over 50% since 3 years ago's March quarter, and the revenues are going to be dead flat. And it doesn't make a lot of sense. But when things turn, as we saw in 2022, they can turn very quickly. And so right now, people are trying to make the case that, hey, this isn't this is not a big issue for Apple, and they're trying to
Right.
say, oh, Vision Pro is going to somehow save them. And I think what we're going to find out as we go through the year is this is a competition problem, which is a much different issue, and that can be long lasting. So I'm more worried about that than what's going on in China from a regulatory standpoint impacting them, because they do want to have jobs, but they'd rather have that in their own companies versus an Apple to some degree.
In a note you sent to us last night, you said that you believe Elon Musk is the Thomas Edison of our generation, but you remain skeptical on being long the stock precisely because of the reasons Tesla, that is, precisely because of the reasons you stated, including rising competition, costs, and so on and so forth, and of course higher PEs than some of their peers. Just talking about the fundamentals of the stock now, Dan, you know that every single other automaker on the planet basically already has an electric vehicle pipeline and are developing EVs across all price spectrums. What then is still Tesla's competitive advantage in the auto sector? I know they have other products in their top line, but just talking about the cars specifically.
Well, I mean, I think the biggest thing is they've got the most data of anyone on the planet as it
Hmm.
relates to self-driving. And so if ultimately you believe that they can become successful in getting that out, and obviously there's a lot of political pushback against them because they're not unionized. And unfortunately, in the United States, under the current administration, obviously, that puts them behind the eight ball. And so they're getting constant pushback from the US government, which I anyway, which is disappointing given
Right.
all the things that they've invented and given that we'd like our companies to be global leaders in the industry.
Sure.
And they are the leader by far in terms of technology, but if you're constantly under pressure by your own government, that's going to enable others outside of the United States to catch up. And as we've seen with the Detroit Three, they're trying, but they're not doing as well as a Tesla is doing. And so I think at a 60 PE and estimates going down, don't forget, estimates went down about, if you look at the December quarter they reported, relative to where people's expectations were for the December quarter a year ago, they went down almost 50%. The stock doubled, but that was last year. That's not what you're seeing today. And as I said earlier, David, I think
Yeah.
this year you're going to actually have to put up the numbers because the stocks have all discounted massive beats and raises, especially in tech, the Magnificent Seven going out for a long period of time. That's not what you've seen during earnings season so far. And so that's why I think with Tesla, as much as I think Elon Musk is an absolute genius, I'm a
Hmm.
big fan of what he's done to change the world. It's hard to like the stock, and you have to kind of separate those two, because at the end of the day, stock prices and earnings eventually, they didn't matter last year, but so far this year they are mattering. Those two things have to line up, and you line them up through whatever the multiple does, and typically multiples will contract if thoughts about future growth go down.
Okay. Let's talk about the economy now. You mentioned several times that throughout the interview that it's possible that the economy could slow down the second half of the year. Can you expand on that?
Sure. I mean, I think, as I said earlier, people have been wrong about consensus expectations for the past
Sure.
3 years. And obviously, going into last year, people thought, oh, we're going to get a recession. And clearly, you had GDP growth of 5% in Q3 and 3% in Q4. So clearly, no recession last year, and stocks did incredibly well. This year, because of that, everybody's convinced themselves, oh, there's going to be no recession, it's going to be soft landing or no landing, whatever you want to call it. But the question you have to ask yourself is, well, did we just delay the normal impact of monetary policy? And what I mean by that is, um, while the Fed was hiking, consumers had at one point $2.5 trillion of excess savings in their savings accounts because of all the stimulus checks that went out. And so the normal impact of a rate hike didn't occur because you had all that excess savings. Now, by most estimates, all that excess savings of 2.5 trillion has been burned through for 90% of the population. So are you going to see some of that starting to hit finally? Also, you had things like student loan repayments where people didn't have to pay back student loans for 3 years. That restarted at the end of last year. And then you had a lot of consumers refinance their debt, especially mortgages, at very low levels. So is that going to, now start to reset after you've gone through a period of time where interest rates have gone higher? I'm personally believe that there's a decent shot we get a soft landing for one simple reason. It's hard to get a recession if you don't have a problem with jobs. And right now you have about 40% more job openings than people unemployed. So it's going to take a lot of job destruction to get yourself into a recession. So I'm actually in the camp of a soft landing, but remember, the last time we had one of those was in the mid 90s. And so they're very tough to pull off. And I look at what's happening at, New York Community Bancorp, and you have to sit there and go, is this just a sign that the bank failures we saw in March of last year, the problems aren't over yet? And the commercial real estate issues now are what we need to worry about, where last year it was the fact that bonds were selling off so much that they were causing banks issues. Is the problem going into this year the fact commercial real estate still has issues because we're all doing hybrid work? And so we'll have to see. So I try to keep an open mind on this because remember, valuations are very high relative to where inflation is historically.
Just in the jobs aspect, one point of pushback may be, Dan, that uh, the labor market is a lagging indicator, meaning that while job openings are still, I guess, prevalent and the unemployment rate is currently still low, it will take some time for the lag effect to kick in. And if you look at the news every day, there's new companies laying off workers. I'm just opening up Google right now. Snap is laying off 10% of its workforce as of this morning. There's a lot of headlines like this from all over the news, mainly in the tech sector. How would you respond to this?
Yeah, the tech sector, I know it makes the headlines because you've got
Right.
all these big tech companies. Believe it or not, it really doesn't matter.
Okay.
Most of the job creation is in the private sector. And so there in the services space, particularly because we're still sort of in this period of time where during COVID, right, services went away. You weren't going to restaurants, you weren't going to movies, you weren't going on vacation. A lot of services jobs got destroyed. And so, yes, you're absolutely right. There's layoffs in the tech sector, but where the job creation really comes from is small and medium business. And so that's where I think it's like 75% of the job creation comes from. And there, the market is very strong. So are you having issues at the higher end at some of these tech companies with their layoffs? Absolutely. But are you having a lot of job creation at the lower end, which is good for that segment of the population that can least afford what we've had to deal with inflation?
Right.
Yes, you've got a lot of job creation there. So I watch the weekly jobless claims. It comes out weekly, as the name would imply, to
Hmm.
really get a good feel for what's going on, because you're absolutely right. Unemployment rate, the monthly jobs numbers that come out, they are lagging indicators. And what's worse is they get adjusted in hindsight,
Hmm.
and which doesn't really help you, because the government, I wish they would just give you the numbers instead of seasonally adjusting and doing all these other things to it, because it just completely screws up the data, in my opinion. But that's why I watch the weekly jobless numbers. Hopefully a little bit better real-time indicator of what's going on, and that still continues to be pretty good.
Would there be something the Fed could do, like a mistake that the Fed could do that would throw the economy off and change your mind about the soft landing thesis?
No, because I think the Fed, Jerome Powell is human. The last person to pull off a soft landing was in the mid 90s. So would he like to go out, because if President Trump gets reelected, he said he's probably not going to reappoint him. We'll see what President Biden does if he gets appointed. But I think Jerome Powell, in the back of his mind, he's got to be thinking, if I can pull this off and get a soft landing, it would be incredibly rare. And he's made mention before that if he waits for inflation to get down to 2%, it would be too late, because as you and I talked about before, policy acts with the lag. So he's not going to cut in March. He made that very clear in his last press conference. But I think he will start to cut in May, June, July, because he doesn't want to be perceived as playing politics with the election. And so I think he does want to get 3 rate cuts in, but he wants to get them done early. We know it's not going to do it in March. So I think that gets you into that mid-year time period starting in May. And so I do think we have a decent shot, believe it or not, at a soft landing, assuming the job picture stays good. And the second piece of that is assuming energy prices stay under control, because that's the other thing that can throw you into a recession when you look back historically, is if oil prices spike. And right now they seem to be hanging out in that 70, and change range, give or take. And so that's a good thing if it can kind of stay there, because that won't cause problems going forward. Obviously, what's going on in the Red Sea is an issue in terms of transportation costs for goods that get sold in the United States. It's got to take a lot longer to get here. It's going to cost more money. And so that's another thing I'm keeping my eye on, is transportation costs. But for right now, it seems manageable, and we'll have to see where it goes, just because the economy is so strong. And the good news is China also, their economy has been an absolute disaster. They came out of COVID last year, and it just has not picked up. And finally, it looks like this has gotten the attention of senior leadership in China, and that they might have to try to do a few things to get their economy going, because their view on whatever you want to call it, they call it welfarism, encourages laziness, is the way they put it. President Xi puts it, or that people should take a bite of bitterness for the young people that don't have jobs. And so their view is a lot different than in America, where every time you run into a problem, you hand out free checks. That's not the view there. The bad news with that view is that it means that things can get really ugly. So if you reach the point where the world's second largest economy is acknowledging that things have gotten so ugly and is really hurting their people that they need to do something, then that helps the entire world. And it seems like we've gotten to that point, as the stock market gives you a daily reading of what's going on, and that can't be making them happy going into Chinese New Year. So we'll have to see how that plays out.
Back in the U.S., are you concerned about corporate debt maturing this year and having to refinance at much higher rates, thus bringing down their margins?
Yeah, no, absolutely. And that's one of the things I'm watching. The other thing is, you have to also worry about the fact that there's going to be a lot of treasury issuance this year. And so, the estimates range up to close to 10 trillion in treasury issuance, between the deficit at about 2 trillion and treasury securities maturing that need to get refinanced. All of that creates upward pressure on interest rates. And so that's definitely something that I'm watching going forward.
Okay. Overall, then, your view on the equity markets, I'm assuming, just based on our discussion, that you think there's going to be more upside for the S&P 500. Am I correct?
Well, the way I manage the stock, I manage my portfolio daily. So I have long-term thoughts of what I think will happen, but I look at the daily data and I let that inform my decisions. Right now, my thought is, first half of the year, could the market be up another 10 to 20%? Absolutely. I think you get rate cuts in May. There's an old saying on Wall Street, don't fight the Fed. But as you and I talked about earlier in the interview, monetary policy acts with long and variable lags. And so I am watching the data very closely to see, okay, are we getting head faked yet again or not? And so I think you have to keep an open mind around that, for a lot of the reasons you and I discussed, debt maturing, treasury issuances, deficit, all of that. And obviously we have a lot of geopolitical stuff going around the planet, and all of that's something you need to keep in mind. And I think being flexible is key this year.
And I think the point of, if I may summarize, Dan, I think the point of what you're trying to say is that a recession is not the only thing that could bring down the markets potentially, right?
Absolutely. Multiple contraction
Right.
could really hit you, because right now everybody wants to believe these tech stocks are absolutely immune from everything that's going on, and that somehow, even if you're having a problem like Apple, there will be some way you bail yourself out. And so they're justifying incredibly high valuations on some of these names without the underlying growth to support it. And so multiple contraction in the short term is always what drives markets. Earnings over the long term is what drives markets, but in the short term, it's the multiples. And you look at the S&P trading at 20 times, it's not exactly cheap relative to where inflation is sitting for CPI and where growth is for the overall market. The big tech stocks are doing fantastically well in terms of earnings growth if you aggregate them all together. But if you look at the overall market, the earnings growth isn't so robust when you take out the tech stocks. In fact, they're down.
Okay, we'll put the website down in the link below in the description. Thank you very much for your time, Dan. Appreciate it.
Thanks for having me on, David. Appreciate it.
We'll speak again soon. And thank you for watching. Don't forget to like and subscribe and follow Dan in the link down below.